February 3rd, that is when jobs data comes out. I will be streaming jobs data live at 5:30 a.m., and that could actually shift sentiment for the good news that we're seeing in the stock market now following Powell. But the jobs data itself tomorrow won't be the big catalyst that we solely want to pay attention to, because there could be a lot more. And in this video, I break down what to pay attention to at the Federal Reserve now that Jerome Powell has started to tell us that the beginning of disinflation is here. Let's take a look at that link down below. Remember, February 3rd, jobs data 5:30 in the morning. February 3rd, 11:59 p.m., expiration of the coupon code, linked down below for the lifetime access to the programs on building your wealth. Most popular right now, Stocks and Psychology of Money, the Do-It-Yourself Property Management, bundled with the Zero to Millionaire Real Estate Investing course, and the Elite Hustlers course to build your business, grow your business as an entrepreneur, or grow your income as an employee. So we've got courses on building your income from investments and building your income from your job, and strategies, tax tricks, liability tricks, and a lot of great information that's very difficult or potentially impossible to get anywhere else. Thanks so much. Look forward to seeing you there, and let's get into the content. All right, let's talk about what's next for the Federal Reserve. After dovish comments from Jerome Powell yesterday, which were surprisingly more dovish than we expected. I mean, essentially, Jerome Powell, the more he talked, the more the market went up. Usually it's the opposite. The more he talks, the more the market goes down. And I think it's really important to start with an inflation discussion and what we really need to see happen in order to see Jerome Powell's dovishness continue. So I'm going to show you exactly the sectors that you want to pay attention to when it comes to inflation coming down. It's not goods inflation. We know that goods are already disinflating, coming down in inflation rates. We know that housing and shelter is expected to start showing massive declines for inflation, which could help anchor the inflation reports down substantially. However, Jerome Powell is concerned that when you look at inflation, X housing, X energy, X food, basically you just look at what they call the super core of services, which is where higher wages could hurt inflation. The following are the sectors that we're looking at. On screen now, we have water and sewer and trash collection services, domestic services, lawn mowing, repair of household items, medical expenses. That's a big one. Medical expenses sitting at about nearly a 7% weight. Professional services sitting at about a 3.4% weight within that. That would include physicians, dental, eyeglasses, hospital services. Notice that in hospital services, in the last CPI report, we actually got a 1.7% inflation read month over month. That's pretty high. That's pretty aggressive, though we did get a substantial drop in services by other medical professionals. So medical care services overall only increased about 0.1%. But if we see a jump in that in future inflation reports, we could actually be setting up for potentially a negative inflation surprise. So I want you to pay attention to medical services. Transportation services, car and truck rentals have been plummeting, for example. Vehicle insurances, public transportation, including airfares. We actually kind of expect the potential for price wars to start coming to airlines. At least this is roughly what we gleaned from the United Airlines report, which is a way of potentially saying, hey, look, if you get price wars at airlines, we could continue to see airfares drop, and public transportation makes up about a 0.9% weight on CPI reads. Recreational services holding about a 3.1% weight. That'll be another important one to watch. We've got education and communication services, 5.3% weight. Admission to sporting goods, miscellaneous personal expenses, haircuts, apparel services, financial services, tax prep services. These are the sort of services that the Bureau of Labor Statistics will report data to us coming up here in 12 days on Valentine's Day, and they're going to be very important for what the Fed is looking at. So if you're looking at, okay, where do we want to be cautious? Where do we want to potentially pay attention for increasing prices? It's those services sectors. So maybe pay a little bit more attention to what you're getting from companies that are reporting service style revenue. So maybe pay a little bit more attention to the advertisers, which we'll talk about later, such as a Trade Desk or Facebook earnings or Google earnings. Maybe pay attention a little bit more to what we're seeing at those airline services, and are we seeing any of those pressures subside? A lot of companies, when it comes to inflation, seem to be expecting deflation or deflation, or at least disinflation, by the second half of the year. Giving you, for example, the consideration of even AMD, suggesting that their pipeline, and this is a little bit more good style inflation, right? But for AMD at least, we expect to see more discounting on the older pipeline of products. That's disinflationary, right? Helps bring our goods costs down. Pulte Homes, discounting homes more. Okay, eventually that feeds through, pushing real estate prices down, pushes rents down, brings down that housing inflation. GM, discounting vehicles more. Great. Maybe that discounted vehicles, which is a durable good, will eventually translate to lower prices in car rentals, because if cars are cheaper to buy, then they're cheaper to rent out for transportation purposes, right? Important. Johnson & Johnson, Procter & Gamble, higher inflation at the beginning of the year, but expecting lower. But again, that's more on the product side. So we'll really want to start switching to paying attention to earnings for companies that are providing us services. And is it possible that technology companies could lead deflation in that sort of sector? Are we going to see lower earnings at companies like Adobe and Autodesk, or software as a services companies, which basically drive input costs for a lot of service-based companies? And could those sort of reductions in price competitiveness lead to disinflation in those areas? Maybe, but is that going to change anything over at medical care services? TBD. That's going to be a sector that we really want to pay attention to going forward. So we'll see. But beyond that, the Federal Reserve quite substantially excited about the disinflation that we're starting to see. And Jerome Powell does tell us that he expects to start seeing disinflation start impacting the services sector soon. That is their base case, that even though it's running a little hot right now, they expect to see it come down very soon. When? He doesn't know. So he doesn't want to come across as optimistic or bearish, or pessimistic, should I say, about what's going to end up happening with inflation in the services sector. But it's going to be a sector we want to pay attention to. And one of the ways that we could do this is, again, when we look at earnings reports that come out, you want to see more belt tightening in terms of employment. Nobody wants to see people get unemployed, but the less wage pressures you end up seeing, the less pressures you might end up seeing on services, right? The lower cost or the lower expense you have for hiring people who are going to prepare tax returns, or the lower cost for dental hygienists, all end up meaning the lower prices that companies end up having to charge their customers. And you can actually create GDP growth without substantial inflation. So we'll see. But what we got from Jerome Powell was relatively dovish yesterday, and we are seeing a lot of signs of disinflation. However, they create a substantial risk that if for whatever reason we end up seeing services run hot, like those that I mentioned, you could end up having a pretty quick downside in stocks and a pretty quick rally in treasury yields. So in my opinion, one of the things that you want to be careful of is as much as I'm invested into the market, and as much as I'm excited about the market going green, because it's been quite a wait for the market to start rallying again, I think it's important to look at your portfolio and say, look, if you've got margin, maybe start taking a little bit off the table as we get into sort of a rally mode, or maybe you start seeing a little bit of a U-turn in the rally. People start selling the rally a little bit, or maybe going into CPI on the 14th. Maybe you start selling just a little bit just to get out a margin and pay off your margin. Have a little bit of cash on the side, so that way if we start getting any kind of inflationary surprises, which I expect there will be some inflationary surprises this year, maybe then you have more capital available to buy the dip between now and say the middle to end of this year. So some things to consider, along with obviously what's going on with China, because another thing with China is as much as I believe the inflationary boost that we're going to get from spending in China is going to be somewhere around 1/6 of what we saw in America. This is solely calculated by the excess savings that are estimated for the Chinese population versus the American population following the release of COVID lockdowns, suggesting that the Chinese have about 1/6 of the money that we had coming out of COVID lockdowns. You still have the potential for surging demand in China, leading to some kind of boost in inflation. AMD, for example, talked about how and this is potentially a counterpoint, how they invested about $1 billion in their supply chains to be prepared for a return to demand. I think a lot of companies are doing that. So I think the Chinese have less money than Americans. On top of that, during the reopening, on top of that, I think you've got companies that are substantially more prepared. This is my scrunchy example. Companies are a lot more prepared for basically a surge in demand now to prevent inflation than what we saw in 2021 and 2022. Nonetheless, Bloomberg still argues that the Chinese reopening is set to provide a welcome boost to global growth. However, it could also boost inflation as central banks are struggling to get inflation under control. And we could see that pressure on oil and gas prices. We could see that pressure on commodities. This is a very common trade right now, is the belief that oil and gas prices are going to rise, that commodity prices are going to rise, and that really this extra demand is going to fuel the items in sort of our markets that we can't just create more of. We can't just as easily create more oil as we'd like, and we can't just create as much copper as we want to be able to sustain some kind of reopening in China. Again, I think that reopening is going to have 1/6 the pressure of the United States reopening, and I think supply chains are in substantially better places than now than where they were then. But you also have to consider that when the United States reopened, we were only sitting at probably somewhere around 200 oil rigs actually operating and drilling at the time, whereas before the pandemic we were sitting at somewhere between 600 to 700, and now we're sitting back at about 600. So you've, even in the oil markets, got substantially more rigs online now than you did during the reopening of the depths of the pandemic, because oil companies were hit so hard and had to take on so much debt to survive, especially when oil went negative, that they ended up shutting down rigs and laying off oil workers. And it's taken a few years to get those folks back and to get rigs back online. In my opinion, that suggests that even with the reopening now, you could see a substantial absorption of Chinese excess demand without seeing substantial boosts in inflation. We'll see. Like I said, the biggest concern for inflation is going to be in that services sector. Yes, there's obviously going to be the concern about commodities price inflation. I'm personally not concerned about that, but I know a lot of traders are making bets on that. I think the biggest thing we want to pay attention to is the potential for higher services inflation. That could be something that actually derails Jerome Powell's optimism. It's very possible that if services inflation starts ticking up again, that the next summary of economic projections might end up being a U-turn, kind of like what we got from Jerome Powell between November and December. In November, Jerome Powell was pretty optimistic. Then in December, all of a sudden, he turned hawkish again, and we got the most hawkish summary of economic projections ever in this tightening cycle. And that same kind of thing could happen again. I don't think that's my base case. I would just call that sort of the edge scenario of as exciting as it is that markets are running, and I'm very happy about that, and I'm substantially benefiting, obviously, from the market rally, and I want to see that continue going on. I don't think it's wise to be to think that inflation for sure is over. There are still risks on the horizon, as we saw with the Bank of England raising rates 50 basis points today, ECB raising rates 50 basis points, both of them talking about inflation risk being skewed to the upside. There are risks, especially in that services sector. Now, is it possible that Powell, the ECB, and the Bank of England are, as I've previously said, keeping on that hard mask to make sure that inflation expectations don't unanchor? Absolutely. Totally possible that the central bankers are just acting tough in order to pressure inflation down. Hopefully that's the case, right? And I believe that's the case. That's why, and I want to be very clear, so there's no confusion, I'm long this market, and I'm very happy about that because I do think that inflation will plummet. But I do think there's the potential for some minor, at least, upside surprises in the services sector. And so it makes sense to have a little bit of dry powder, a little bit, maybe 15% or something like that, available for potential dip opportunities when we go back into red weeks, because there always will be red weeks again. And it's something to remember is when a rally starts, is that yes, enjoy the rally while it goes, but there will always be another red time in the future, so keep that in mind. But again, my longer-term thesis is that whether you're all in now or you're dollar cost averaging, just stay safe for the potential downside risk that will probably end up being temporary. As long as you can survive potential short-term drops to the downside, I think we are on that Nike swoosh recovery, and things are going to be substantially more positive than they are going to be negative. Now, this is only true, though, if you're listening to folks that I think are trying to have a balanced view of the market. There are unfortunately some folks that are real big bears who just refuse to believe that it is remotely possible that inflation could go away. And that, for example, would be somebody like this dude on Twitter named MacroAlf. Now, don't get me wrong, I'm not trying to bag on him. I like his negative points of view because they serve as sort of like a contrarian reminder. He's a big fan of saying the first innings of a recession always look like a soft landing. That first, the labor market weakens, but not enough to generate substantial job losses. And it's really only once you get substantial job losses and earnings decline that and inflation drops that you realize, oh my gosh, this recession is terrible, and then things get really bad. So in other words, you've got this individual saying, look, things are going to get a whole lot worse before they get better. And this sort of is reiterated by people like Michael Burry who say sell, or other people who say, look, as soon as the Federal Reserve pivots, things are actually going to collapse even more than they already have. I personally disagree with that assessment very heavily. The reason I disagree with that assessment very heavily is because the recession that we face today, potentially, maybe we don't, right? Maybe we don't even go into a recession, but the recession we face is one that is induced by the Fed. This is a manufactured recession. It's known as forcing a recession, or at least forcing the market close to a recession or close to recession. This is what I talked about in January of 2022. I said that if inflation went hot, the Fed will force a recession, especially if we get a wage price spiral. Now, the good news is Jerome Powell believes the odds of a wage price spiral have actually been diminishing. This is very good because it means that maybe we don't have to get a forced recession. And that is the key, is the Fed does not actually have to continue engineering layoffs. The Fed can and will U-turn on needing to continue to engineer layoffs and a forced recession. And that's what makes, dare I say, this time different from prior recessions, is that in prior recessions, you had really structural issues in markets. Let's look, for example, at the structural issues of the Great Recession. Dead people getting housing loans, rampant speculation for real estate, basically people with terrible credit scores getting these insane adjustable rate mortgages where they were being offered negative interest rates to lower their payment up front to let them qualify. But then in 6 months, their interest rate would adjust to from negative something, negative say 1% to like positive 7%. And people were signing up for that because housing prices were just going up so fast that people thought, oh my gosh, I'll just refinance in 6 months and I'll just do it again and I'll get rich through real estate. It was kind of the same kind of bubble mechanic and structural problem that you saw in the dot-com bubble. What makes really this recession different, and again, the four most dangerous words in a recession or really in any kind of market are this time is different. So keep that in mind, okay? Like that is a risk factor. But what does make this quite different is that as if inflation continues to go away, and keep in mind, I've been cautioning that there are parts of inflation that could still pop up, especially in that services sector we talked about. So we started this on. As long as inflation continues to go away, the need for the Federal Reserve to create joblessness is gone. The need for the recession is gone. The only real structural problem right now, with the exception of a potential black swan that could pop up like a debt crisis or something crazy, the only major issue we face right now is inflation. That's the structural problem right now. As soon as you take out inflation, what do you have? You have people who have more wealth than they've previously had. You've got very good lending in real estate. You don't have dead people getting loans. You've got highly qualified people getting loans, higher credit scores than ever before. Yeah, you've got problems in places like the car market, and defaults are starting to kind of return to 2019 levels. But are we seeing the levels of defaults that we saw in the 2008 recession suggesting massive financial pain for people? No. Obviously, inflation is a bitch, People are spending more money at grocery stores. Eggs are more expensive. Hamburgers are still very expensive. Burritos should not be $14. There are issues. Prices have gone up. But as long as that increase goes away, it's entirely possible for the Fed to maintain this U-turn stance. And that's why I have the belief that it makes sense to be more long-term bullish, but also protected. And so that way, in the event we have some shocks to the downside, you're ready to either survive or potentially buy the dip. Remember, you should not be buying the dip if you're not potentially capable of surviving. Right? Like, don't buy the dip with margin. So that's my belief. And that's why I believe really this pivot from the Fed, which would be a pause or a reduction in rates, is completely different from prior pivots where the Federal Reserve was kind of like, wait a minute. I mean, if you look at, like, the Federal Reserve was not driving the prior recessions. If you look back at the 70s, what happened? Well, you left the dollar, you left the gold standard, and you were just getting off of insane price caps. So in other words, you had price caps from earlier presidential administrations in the late 60s and early 70s. Those price caps got removed. Prices skyrocketed up. People were like, oh my gosh, everything's getting more expensive. Yeah, because you removed the price caps on stuff. Now you also left the gold standard. Oh my gosh, inflation's going to stay here forever. Expectation of long-term inflation. There's your structural problem. What did you have in the late 80s? A savings and loan crisis, speculative real estate lending, just like you had in 2008. What did you have in the early 2000s? A dot-com bubble, which was driven by euphoria and massive rampant speculation and profitless tech companies, which you don't want to speculate on. I think it's a terrible idea to speculate on profitless companies. So those are some of the structural issues that you faced. And so when the Federal Reserve was raising rate or reducing rates in some of these prior eras, they were actually kind of like, can we avoid a recession and can we try to stamp out some of the excess and these other, structural issues without creating a recession? That was sort of the prior thesis. And this is why you saw rate cuts lead to further drops in markets, because the problem of the market was not the Fed. The problem of the market was something else. In this recession, the only problem we have is the Fed and inflation, right? The Fed's fighting inflation. So however you slice it, when the inflation problem goes away and the Fed starts cutting, I think we probably go back to the trend of the Great Moderation. Now, if you don't believe in that, then don't be long the market, right? Then this is just a bear market rally and we're going right back down. But that is one way of looking at things. It's not saying that I'm definitely right. But for me, look, I'm taking every opportunity to expand my palette of pricing power style stocks and expand my exposure to stocks that exhibit substantial pricing power, leads ahead of their competitors, massive investments for potential, either more capabilities in the future, more innovation in the future, higher margins in the future, right? We are going through sort of a recessionary time, so you have to play the long game a little bit. But I'm a big fan of companies with cash flow, the potential for high margins or present high margins, and innovation, because I think all those sort of companies massively on sale still even today. So that's sort of my thesis. We'll see. We'll see though. Again, risks, China inflation, services inflation. That's probably your biggest risk. Then on the small end of the spectrum, you have the black swan scenario, which would be a risk of some form of massive debt collapse, breaking of the bond market because nobody's buying bonds and the Fed all of a sudden has to jump in because everybody's parking their money into repos. I don't know. So far, things are orderly. Is there a potential of big black swan? Absolutely. Is it as obvious? Like, is the downside ahead of us now as obvious as the downside was in January of 2022? No, not at all. Like, we're in almost the opposite scenario of where we were in January of 2022. January of 2022 was hell. Every company was bragging about how they were able to raise prices and people were buying. It was insane. It was a bubble. And it was a stimulus-induced one. And now we're paying the price for a stimulus-induced bubble via high inflation and via the Fed tightening cycle. And as soon as that inflation is out of the system, the structural problem is gone, Fed can go back to a looser monetary regime. That's my thesis. And so that's what I'm making my bets on. And again, I don't want to be that person that's just going to sit here and be like, all right, guys, just buy the S&P 500 and don't pay attention to financial markets. I don't believe that. So I like playing financial markets. And in painful times, I like increasing my allocation to companies that I think are going to do really well for the next decade, whether that's energy, chips, tech, pricing power stocks, whatever it may be. But that's my personality. You don't have to agree with that. So, but either way, I appreciate you for watching.